Apple dropped 10% on Thursday's trading session. Along with that, we see the continued yield curve warnings, the propaganda from regulators suggesting that everything is just fine, and the constant determination of the plunge protection team. In the end, however, the Fed will dry up liquidity and ensure this market sinks to the ground. You came here for the truth, so let me unveil that for you. Today, we're going to look at what happened in the markets. We're going to talk about the LIBOR. We'll talk about the Fed funds rate. We'll talk about gold and so much more. So let's get into it right away. In the video I did earlier today during the middle of Thursday's trading session, we saw Apple falling down and it ended up falling down 10% by the end of the day. The stock is sitting at 142. The market cap is at $675 billion. This is a particular stock that was once at $1.1 trillion and it has fallen ever since. Everybody has their eyes on this corporation because it is massive, it is well known around the world, and certain individuals have bought a lot of shares. Berkshire Hathaway, all right, we're talking about Warren Buffett here. The stock had fell 5.6% in this trading session. It has been rocky for this particular company, just like all others from October and beyond. The stock is up and down and up and down. It looks like over the last year it is actually in the negative. This is not good. Now, one of the stocks that they own a considerable amount of is Apple. I'll show you here. You can see Berkshire has not fallen this percentage in a single trading day in a very long time, other than just a few instances. So that's a company that is always really doing well and being able to show continued performance. However, their Apple stock declines, and because they have such a large stake in the company, then it will affect their performance. Billionaire Warren Buffett has said that he would love to see Apple shares decline in price so that he could buy more. He's getting his wish. Of course, we saw what happened in this trading session as a result of the report that was put out by Apple the night before after trading closed. They suggested that everything is not going to be the way that it was estimated it would, and so the market took it to heart, and of course, the stock declined. That affects Warren Buffett, that affects Berkshire Hathaway as a result. Now I want to cover what's happening with the yield curve inversion, with the federal funds rate and more. 2-year yield dips below the key Fed rate for the first time since 2008. Very important to watch what's happening with the Federal Reserve and then linking that back into the financial crisis. The US 2-year Treasury note dropped below 2.4%, reaching parity with the Fed funds rate, and that hasn't happened since the financial crisis. Everybody needs to understand that when you have these repeated patterns, it should be sending off these warning signals in your head to get ready. We don't know when it's going to happen. We don't know what exactly is going to occur, which triggers are going to be met. But I can tell you right now that cycles do repeat, and it's only a matter of time. This has been a long bull market, to say the least. There's no doubt about that. So we'll see what occurs and how it all plays out. But I wanted to give you the details and want to show you as it happens. This is a chart interconnected with it. You can see the black line, which is the Fed funds rate, and that is currently sitting at 2.4%. Then you're seeing the 2-year, 3-year, and the 5-year actually going below that. So imagine if you can't stay above that, you've got something going on. And that is what is happening today when you look at the Fed funds rate constantly remaining too low. The market doesn't know what to do with it. So that's how you had that dislocation, that disconnection from reality, and now we pay the price. Everything today is a result of what was done previously. They always want the Federal Reserve to react somehow, but that doesn't work like that. You cannot somehow have this continued manipulation of interest rates, of what's happening in the market, buying up all these mortgage-backed securities, buying up all these asset-backed securities, trying to monetize the debt, and have this be a solution to the problem. It isn't. And in fact, we're going to experience something much worse than we had 10 years ago. with all of the market turmoil, we are seeing a few events take place that I find very strange and are truly troublesome to anyone that is paying attention. First, we had the little munchkin. He made some phone calls around and said, "Is your company really good right now? Is your company safe and sound? Yes? Okay, I'll take your word for it. Thank you very much." So after he was done his phone calls, he put that information out to the public, and then suddenly the traders thought, why is he telling us this? That's not good. And so the stock market dropped significantly as a result. Then we had the OCC coming out and saying basically the same information. Everything is just fine, nothing to see here. And now today we have the third round. FDIC chair says no concerns about US bank health amid market turmoil. Isn't that interesting? We have 3 different sections all coming out suggesting to us that you don't have any reason to worry. But that usually comes at a time when there's reason to worry. That reminds me of 2008. That reminds me of the preparations that were made right as everything was collapsing. Behind the scenes, they're fixing everything, or at least they're pretending to. And then you have the real situation that's unfolding, and that's all becoming a distraction. People don't realize it because they're only worried about the headlines. Tell me the headlines, and I'm moving on. The Kardashians are on. I don't have any time. This is the LIBOR rate. You're seeing the 3-month LIBOR specifically. That's usually the one that's the benchmark. And you can see that this has been rising considerably. It's doing just what the Fed funds rate is doing as well. This is nearing 3% at this time, and it won't be long before it's back into what it was during the financial crisis. So we'll see how long this takes and if it will in fact increase at the rate it did previously. I don't know personally, but regardless, it has been rising, and there are over $200 trillion worth of financial assets using this rate. So it continues to rise, and of course that puts a burden onto all of these corporations and these traders and everything. Of course it should be higher, but I'm just suggesting this new world that we live in today of excessively low interest rates needs it to be on its life support. Very quickly, just wanted to touch on these 2 charts in a row. Global liquidity net expansion by source. At the bottom, it just gives us the legend. The policy liquidity stock, that's the red, and the private sector liquidity stock, that's the yellow color. And all I wanted to note from this was that these have been declining throughout 2018. Just like all of these central banks, and what they're doing with their policy today is not what it was in 2017. G4 yield curve and global liquidity, both of these again declining over the last few years. There are so many different yield curve inversions taking place. I can't keep track, but this is the one in the 10-year curve, and of course it is just barely above, but it looks like it will be any day before this inverts as well. One after the other, they are all doing the same thing, all tracking each other, and once that inversion happens, it doesn't immediately send off a trigger and that's it. Okay, we're in a recession, but it is a leading indicator of that. And then we have to talk about gold. You're seeing the gold price as I record this just under 1,300. I believe at one point it actually exceeded 1,300. However, at this time it's showing 1,295 at gold price here. The silver price 1,582. This has been basically tracking along with what happened with gold. Over the last year, gold has been actually outperforming the S&P, but it hasn't been into the positive. Okay, it's down 2%, but we are looking for a time in which safe havens are necessary and are more popular amongst investors. Right now, it's only really since October that the market has been suggesting, okay, everything's not fine as they told us, maybe I should buy something else. So this is what happens, and it's usually not physical metals anyway. We're talking about paper, but this is what we can experience when we have a decline in the stock market. Then we'll see some activity happening with gold. If the market feels that everything is just fine, then you will probably see gold go down. That's just the way it is. It's always the last ditch, last thing that investors are using to trade. Even Jim Bear Stearns Kramer actually suggested it at one point. He's probably gone back on that by now, but anyway, that's where we're at today. The Japanese stock market declined as well. This is in a bear market today, despite the massive, absolute massive injection from the central bank that refuses to give up on the sheer amount that they have printed and tried to buy everything. They own approximately 80% of all the ETFs. They own 40+% of the bonds. They own a majority stake in many of the biggest names in their stock market. This is a failure. If you want to know what QE does, this is it. It reduces the value of your currency and it destroys future prosperity. Last but not least, announced layoffs in the US construction industry just shot up like crazy out of nowhere. This is now the biggest on record from what I understand. It came out of nowhere. You'll look at this chart here from 2012. Other than the spike in 2017 very briefly, it's basically been absolutely at the bottom. But today, everything has changed. So that's interesting just to see what occurs with that. I don't know if it's going to turn around next month or that's going to be a continued trend. I will try to give you some more data on that when I can, but I think it's interesting because these companies may see the writing on the wall. Now I've heard that the data has come in about construction on single family and multifamily homes actually declining right now in the United States. So this could have an impact, of course, on the construction workers. We'll see if that's the case. This is not just one indicator. You can be able to tell everything. You need to see, a good 20 or 30 different indicators to be able to tell what's happening in a particular industry, just to have an idea of it. So I'll give you that data when I have it. I'm going to finish the video there. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. And last but not least, if you want the financial education you were not taught in school, these two books have everything you need. When you get these books, you'll be able to figure out the foundation, the asset classes, how to profit, making money, tax incentives, and everything else from top to bottom, from A to Z. You're going to get everything you need. Check that out at the link in the description. If you want the audiobook version, you can get that at themoneygps.com.